So I get messages like this from, existing clients or new clients. I wouldn't say all the time, but definitely at least a few times on a monthly basis. And there's a common theme here. And the common theme is that, well, what happens when my term life insurance is up in 10 years or 20 years? I don't want to spend a lot, but I don't want my kids to be left with nothing. People are hearing or seeing ads online with regards to investment grade insurance being a great investment and a great way to protect. They're hearing about something being tax free and an easy way to transfer wealth to their kids, not realizing that, in my opinion, in the long run, these products really aren't designed to provide wealth to the people that buys them. They're designed to be as assets under management tools for the financial services industry. They want to take in your premium and give you pennies on the dollar in the long run. Now, that's not to say that these products are inherently bad. I don't think they're inherently bad. I do have issues with them, but my problem is how they're being sold. They're being sold as high growth, savvy products for wealthy individuals or people who want to become wealthy or people who have cash flow, not realizing that in the long run, people are leaving a lot of money on the table over investing in these products, or even ironically, investing in these products at all. A client of mine reached out to me, and we've been going back and forth for a few years, specifically with regards to talking about participating life insurance. And she wants it because her term insurance will be up in 15 or 20 years, and she wants something to be there for her kids. And my argument is the best way to guarantee wealth for your kids or your next generation is to just invest smartly and commit to an investment contract the same way you would commit to an insurance contract. Now, I'm not saying that's easy. There is something about saving, investing that insurance makes easy. Like, it's a bill that you have to pay. And in my opinion, the best way to invest for yourself, specifically long-term invest for yourself, is create that mental switch for yourself. Look at it as a commitment. Look at it like a bill. Set it up so you have no option but to continue with this deposit indefinitely. And I believe the best way to do that is to effectively mimic insurance contracts. What I try to do is, rather than showing people illustrations and show them how great illustrations are, I try to show people how much money they're leaving on the table. So here's a great example of a product that this individual was presented. And she's like a lot of people in their, mid 30s to 50s. House worth, lives in Toronto, right? So house worth, let's say, 1.5 million, $1 million, just under $1 million mortgage. Not necessarily paycheck to paycheck, but not a lot of money left over at the end of the day. Not a lot in RSPs or TFSAs. Definitely feels financially uncomfortable, wants to produce wealth for themselves long term, but really doesn't know where to start. And I understand why these life insurance policies can be looked at as the easy solution, because they, to an extent, are presented as that. And then when you layer in the whole fact that, well, wealthy people are doing it, and we're taxed a lot in this country, and these are tax-free, it seems like a no-brainer. So here's an example of something that a lot of advisors would produce for this individual. And I'm going to go with a 20-pay participating whole life insurance policy. I'll use Equitable Life because she mentioned to me that's the company that she was initially presented to when she spoke with this other advisor. A $500,000 policy, you only pay for it for 20 years. And I'm going to go to the advisor tools here. I'm going to design the report, and I'm going to produce the commission requirement, alternative dividend scale, and I think that's good enough for now. Now, participating whole life compared to universal life insurance is definitely the most commonly purchased investment grade policy on the market. The irony is that it's misrepresented. People think that they're getting dividends from the insurance company when that's really not the case. What they're getting is something called a dividend scale interest rate. And this dividend scale interest rate represents the accuracy of returns. Here's some material from Canada Life specifically. Policy owner dividends arise when the actual experience of the account are more favorable than the assumptions used when the policy was priced. So basically, when you're buying this, they're making a set of predictions. And what I've learned is that these predictions are very heavily based on the prevailing interest rate environment. So they're effectively making a prediction based on the interest rates and pay you dividends effectively based on the accuracy of their predictions. And the problem is, their predictions are proprietary. The insurance companies won't share them with you. So that's why you may hear people in the industry talk about these products being a black box. But in terms of getting to the numbers here, they're pitched as these, high growth and high return products because, when people are pitched them, that's what they see. They see these dividend scale interest rates and they see, oh my God, I'm getting 6.4% of my money. Why take risk in the market making a volatile 8 or 9 when I can get a consistent tax-free 6.4? But the problem is the dividend scale interest rate is not an actual rate of return. It represents the accuracy of a prediction. And if you look at the actual long-term rate of return of the product, I'm going to move across here, show you the internal rate of return, internal rate of return, death benefit, and cash value. And you go down to life expectancy, you're lucky if you're going to get maybe a 5% internal rate of return annually to the age of 100. And that's if the predictions are accurate. Imagine if they're off, the rate of returns could be significantly lower. I have clients who have old policies who aren't getting any dividends and whose dividends are even a fraction of these returns. And the irony is that over the long run, you're significantly better off investing your money in the broader stock market and staying away from these products. Nevertheless, I'm going to illustrate this for you. Paid up addition. So this means all the dividends go to increase the value of the policy. And just to make it some clean numbers, let's go with, why not? Let's stick with a $500,000 policy. Why not? $13,115 a year. And we're going to go to design report, commission requirements. Want to see that in there? Perfect. Based on the current dividend scale interest rate, assuming everything's accurate and the likelihood is low, just based on my experience, let's say this person lives to the age of 90, $2.7 million tax-free. That seems like a lot of money. And look, here's this cash surrender value that you can leverage and borrow against as the money's growing. The problem is, people don't realize how much money they are leaving on the table. And the reason why they don't realize this is, in my opinion, for two specific reasons. One, the insurance companies are misrepresenting the return. So if you're thinking you're going to be getting a north 6% rate of return, maybe not actually afraid of the stock market, but being compelled to be afraid of the stock market, and fear is being instilled in you with regards to why you should stay away from volatility, I can understand why, in my opinion, a shit rate of return like that is looked at as a good rate of return. The second reason is simple: compensation. If you go to an advisor and ask them to invest $13,000 for you, in year one, most advisors are going to make maybe 1%, not even get the whole 1%. $13,000 times 0.01. I could have done that without the calculator. I'm just so used to using it. $130. An advisor is not going to go out of their way to make $130 for you. But if I put a estate planning, tax-free, high-growth product in front of you, convince you to buy this, estimated total first-year commission based on my bonus scale, $18,000. There's a massive incentive to sell these products. Commissions, misrepresentation of returns, equals massive amounts of sales. Now, let's go back to the illustration. Age 90, $2.7 million. Seems like a lot of money, right? Well, what if you could commit to this sort of annual payment schedule for 20 years, but buy the index? And we're not even talking about TFSA or RSP. Let's assume that someone does it in a non-registered account and they have to pay the tax. Basically, I've built a document that allows me to mimic these insurance illustrations, the insurance strategies, just so people can get a sense of what they're leaving on the table here. So let's compare this side by side. We're looking at $13,115 a year. So we're going to do $13,115 a year for investment horizon. How many years? Let's do the age of 100. Let's assume, modern technology, drugs. Let's assume we all live to age of 100 just to make life easy. So 62 years. Let's put in year 62. The investment returns, I go with 10%. The long-term average return of the stock market is around 10%. And that this individual is going to stop paying in year 20. So let's see what this looks like at the age of 100 if you just invest in the index for 20 years, stop paying for it in year 20, let it sit to the age of 100, and then pass away at 100, pay the tax, and give it to your kids. Net cash flow on exit, $20 million. At the age of 90, which was 10 years earlier, let's say 52, $8 million, right there. And this is net cash flow on exit. This is after paying tax. Significantly more than you would have at age 90, and a lot more than you would have at age 100. And that is even after paying tax. Imagine you had TFSA room and you could commit to this schedule. Imagine you had you put in your RSPs and you could commit to this schedule. Now I know what you're saying. Maybe this appealed to you because it was non-registered. And as it grew, you could borrow against this. Keep in mind, the same banks that let you borrow and leverage your cash value against your life insurance policy will let you borrow and leverage your money in the index without actually disposing of your interest in the index. So the reality is simple. People don't realize that they are leaving millions upon millions of returns on the table by overinvesting in these products. Now, I know what you might be thinking. My parents are telling me I should get a permanent policy, or I feel like I want something there when my term insurance is ending. I'm not saying don't get permanent insurance at all. I have some. I definitely use some for leverage. I like it because I like the idea of having long-term liquidity, but refrain from overinvesting. It's very important to do what you can, do your due diligence, and try to mimic these strategies without using a life insurance policy, and compare the numbers side by side. Because I'm telling you that when people do compare the numbers side by side, the likelihood that they go down the road and buy these bloated, I'll call them bullshit, insurance investment strategies, it just makes no sense. Insurance is about managing trade-offs. I'm going to go to my calculator here. I'm going to put in the information. 38-year-old female for $500,000. This is what we were working with. Here's a term insurance rates, and here's a permanent insurance rates. The best rate in the category for term 10, term 20, term 30. Cost of insurance for life pay, cost of insurance for 20 pay. The reality is this. What do you prefer? Do you prefer short-term coverage, where in hindsight it's going to be money down the drain, or long-term coverage, where in hindsight it's going to be opportunity down the drain? There's this idea out there in the marketplace that when you buy that permanent policy when you're young, you will feel so good about it when you're older. I don't know where that comes from. Actually, I do know where that comes from. That comes from advisor propaganda, and advisors and the industry reinforcing its own existence. I have a lot of older clients, a lot of old policies on the books, and I tell you, when I speak to the kids, when I speak to those clients, they regret not putting more money into the index and just exposing themselves more to the stock market. Now, thankfully, all these people weren't positioned these products as these crazy life-changing investments. They were just additional permanent insurance policies. Their broker was their buddy, and they bought it. That being said, everything is a little bit different nowadays. These products are being pushed much more heavily upon the Canadian public, specifically because how much we're taxed, and also because of how high the compensation is. Don't get roped into it. And I'm not saying don't do it at all, but understand how much money you're leaving on the table and make those calculations for yourself before you find the right policy. And so you can find the right policy. Thanks very much.